I want you to think about the last time you booked a vacation.
Oh, yeah. Always a good feeling.
Right. We all know that universal, like almost intoxicating feeling of anticipation,
Mm-hmm.
the escapism, the meticulous planning, the thought of, sitting on a balcony overlooking the Mediterranean or finally hiking that trail you've had bookmarked for literally years.
Exactly. It's the dream.
But what is truly fascinating to me isn't just the destination itself. It's the sheer, fictionless magic of how we actually get there today.
Right, the logistics of it all.
Yeah, you pull out your smartphone, you execute a few deliberate thumb swipes, and instantly your international flights are locked in, your boutique hotel is secured.
And the rental car is waiting.
Exactly. A rental car waiting for you at a terminal, like 6,000 miles away.
Mm-hmm.
What used to require physical visits to a travel agent, flipping through these glossy brochures and paying those exorbitant international phone tariffs, that has all been completely abstracted away.
The friction has just been engineered out of the consumer experience so thoroughly, the underlying mechanics are completely invisible to the average traveler now.
And there's a colossal architect behind that invisible machinery. Welcome, everyone, to this custom-tailored earnings report.
Glad to be here.
Today, we are profiling the heavyweight champion of global travel infrastructure, which is Booking Holdings, Inc. They trade under the ticker symbol BKNG.
And even if you think you've never used them, you almost certainly have.
Oh, absolutely. Their portfolio is just a monolith of heavy-hitting brands. We're talking Booking.com, Priceline, Agoda, Kayak, OpenTable.
It's massive.
And their geographical footprint is staggering. While American listeners might, instantly associate them with William Shatner and Priceline commercials, their true scale is overseas.
Right.
The vast majority of their power is driven by Booking.com just dominating Europe, and Agoda functioning as the undisputed king of the Asia-Pacific region.
They are essentially a global infrastructure layer. Like, the consumer sees a collection of disparate websites, but financially, they operate as a unified, highly aggressive ecosystem.
Which brings us to the mission of our earnings report today. We are going to rip the facade off that ecosystem. We're stripping away the vacation marketing gloss. So no pictures of infinity pools, no promises of sandy beaches. We are opening up the hood of their Q1 2026 financial engine to understand what makes this $130 billion behemoth actually run.
Because it's complex.
It really is.
Yeah.
When I look at the sheer volume of global travel transactions they process, daily coordinating different currencies, languages, legal jurisdictions in literal milliseconds, it honestly feels like an operational miracle.
Okay, well, I will stop you there before we get swept away by the romance of global tourism.
Fair enough.
We're about to rigorously audit these numbers. When you strip away the beautiful user interfaces and the, gamified loyalty points, what you are left with is a ruthless mechanism of cash in, cash out, and a mountain of complex, highly manicured accounting designed to tell a very specific story to Wall Street. Moving to point one. Numbers, drill down, and profit margins let us establish the baseline of their operational reality.
Okay, so the Q1 2026 top-line revenue came in at $5,532 million for the quarter. That is a substantial jump from the $4.76 billion they reported in Q1 of 2025. I mean, it paints a very clear picture that global travel demand is not just resilient, it's actively accelerating.
Top-line growth is certainly healthy, yes, but top-line revenue is vanity. We need to look at the actual profitability of that revenue.
Well, let's look at the operating income then. It landed at $1,271 million. That yields an operating margin of 22.98%. That's a slight bump from the 22.30% we saw in Q1 2025, keeping basically 23 cents of operating profit for every dollar earned in a highly competitive digital market. That's robust.
It's solid on an operating basis, sure.
But here's the figure that genuinely surprised me. The net income absolutely skyrocketed. They reported $1,083 million in net income. That produces a net margin of 19.58%. If we compare that to the incredibly meager 6.99% net margin they reported in the prior year, we're looking at a nearly 13% margin expansion in a single 12-month period.
And that's where the story gets tricky.
I mean, that looks like a masterclass in operational leverage to me. They're scaling the platform without proportionally scaling their costs.
That is the exact illusion the income statement is designed to present. I have to interrupt this assessment right now because you are completely falling for the headline trap.
A trap, really?
Yes, that net margin leap from 7% to nearly 20%. It is a mirage. It is heavily distorted by financing costs and wild currency swings that have zero correlation to their actual ability to sell hotel rooms.
But a mirage implies it isn't real. Like $1.08 billion in net income is a finalized JAP-approved number on their 10Q filing. The money is literally there.
The final number is there, yes, but the mechanics of how it arrived there are what matters to an auditor. You have to look below the operating line.
Okay, lead the way.
Let's look at the financing environment. In Q1 2025, Booking was slammed with an interest expense of $649 million.
Right.
In Q1 2026, that interest expense plummeted to $253 million.
Oh, wow.
That is a $396 million favorable swing on the income statement that was entirely dictated by capital structure mechanics and debt maturity schedules, not by operational efficiency.
So it's just debt management.
Exactly. When you combine that interest expense relief with the massive unrealized foreign exchange gains, which we will unpack shortly, that 19.58% net margin masterclass completely evaporates.
Ah, I see. So the core business didn't magically become 13% more efficient at converting bookings into profit. The macro financial environment simply stopped punishing their debt load as severely as it did last year.
Precisely. To truly understand their margins, you have to understand the fundamental mechanics of their business model. Booking Holdings does not possess traditional cost of goods sold, or COGS, in the way a manufacturer does.
Right, they don't have inventory.
Exactly. A shoe company has to buy leather and rubber. Booking does not buy hotel rooms. Therefore, a traditional gross margin metric is technically undefined and totally useless for them.
So what is their main cost then?
Their equivalent of raw materials, their true fundamental cost of doing business, is the cost of acquiring the customer in a crowded digital landscape. They acquire that customer primarily via Google, meta search platforms, and affiliate networks.
You're talking about the marketing line item.
Yes. Performance marketing remains their most significant cash burn by a colossal margin. In Q1 2026, marketing expenses consumed $2,068 million.
$2 billion in one quarter.
Over $2 billion. That represents 37.3% of their total quarterly revenue. More than a third of every single dollar they generate is immediately surrendered to performance marketing channels just to keep the top of the funnel full.
Wow. Think about the implications of that $2 billion quarterly burn rate in the context of the current technology landscape.
It's daunting.
I mean, we are living through a tectonic shift in how humans retrieve information, driven by generative AI. What happens to this 37% marketing tax if Gen AI search engines fully disrupt traditional link-based search engines like Google?
That is perhaps the single greatest existential question facing Booking Holdings right now. For 2 decades, their model relied on a traveler typing hotels in Rome into a standard search engine, and Booking simply outbidding everyone else to place their sponsored link at the top.
Right. You click the ad, you book the room.
But if travelers transition to asking an AI assistant to curate and book a multi-city itinerary seamlessly, who controls that new top of funnel?
Oh, a great point.
If proprietary AI models become the new gatekeepers of the internet, Booking might be forced to pay an even higher toll to be the integrated booking engine behind the AI's interface.
Or conversely, they have to hope their direct brand recognition, like people opening the Booking.com app directly, is strong enough to bypass the AI toll booth entirely.
Which is a massive gamble.
Right. But either way, that $2 billion marketing budget is essentially a relentless treadmill. The moment they stop spending, the traffic dies.
Which is exactly why we cannot take their operating metrics at face value. Shifting focus to point 2, one-time effects versus operating reality. Let us aggressively strip the noise out of their reported numbers.
Let's do it. So I am looking at the reported operating income of $1,271 million. Since this sits above the line, before those massive interest expense distortions we just discussed, it should theoretically be a cleaner reflection of the core travel business.
It should be, but it isn't. As an auditor, the operating income line is where I expect to find the unvarnished truth of the business's day-to-day viability. But Booking's Q1 2026 operating income is littered with accounting anomalies.
Like what?
Let's start with their general and administrative expenses. Buried inside that line item is an $89 million gain from a lawsuit settlement. Seriously. I always find this accounting quirk fascinating. A legal payout to the company is recorded as a reduction in their operating expenses rather than being separated out.
Yes.
Yeah.
It acts as a contra expense.
Yeah.
It artificially suppresses the true cost of running the business for that quarter, which mathematically inflates the operating profit. Out of that $1,271 million in operating income, $89 million came from corporate lawyers successfully settling a dispute, not from the core operation of facilitating global travel.
So if we remove it,
If we remove that legal windfall, the true operating income drops to $1,182 million. That pushes the true operating margin down from the headline 22.98% to 21.37%. It's a highly material haircut.
it fundamentally changes the narrative of the quarter's efficiency. What else is obscuring the operating reality here?
We have to examine management's reliance on adjusted metrics. In their supplemental materials, management points to transformation costs totaling $25 million.
They explicitly push these costs outside of their preferred adjusted EBITDA calculation. The implication of doing this is to signal to investors that these costs are anomalous. Special one-time items related to restructuring that won't recur.
But are they?
If you dig into the historical footnotes, these exact transformation costs have been recorded in every single quarter since the fourth quarter of 2024.
Wait, really? They have been engaged in a one-time transformation for a year and a half.
Exactly. When a supposed one-time restructuring cost occurs sequentially for 6 consecutive quarters, it ceases to be a one-time event. It is simply an ongoing operating expense of maintaining their modern corporate structure.
That makes total sense.
Removing it to calculate adjusted EBITDA is a massive accounting red flag. It obscures the recurring baseline cost of running the business.
I follow the logic on the operating level adjustments. That's sneaky. But let's look below the line again, because those net income distortions you mentioned earlier are just staggering. The Q1 report details a $333 million non-realized currency gain on euro-denominated debt. Now, I want to inject some nuance here, because Booking operates on a truly global scale. The lion's share of their value is driven by Booking.com, which is headquartered in Amsterdam and transacts heavily in euros. Currencies fluctuate wildly based on central bank policies that are entirely outside of Booking's control. Isn't it required, and frankly fair, for them to report these currency swings according to GAAP rules?
GAAP requires them to report it, yes. Absolutely. But we must evaluate the impact this has on the retail investor's comprehension of the company's quarter.
Right.
Allowing a $333 million paper gain to sit there and artificially inflate bottom-line net income without heavily contextualizing it is deeply misleading. It is non-realized.
They don't actually have the cash.
Correct. They did not actually generate $333 million in cash from this currency swing. It is purely an accounting adjustment based on exchange rates at the exact moment the quarter closed.
But it makes the quarter look like a historic blowout.
Exactly. Furthermore, this was partially offset by $107 million in realized losses on various equity investments they hold, which dragged down the bottom line. The entire net income figure is just a highly volatile cocktail of non-operating financial engineering. The profit is driven by the lawsuit and the mortgage fluctuation, not the core business. What about the point 3? Balance sheet quality and debt check. We must assess the foundation supporting these operations.
Okay, let's open up the balance sheet, because the scale here is just immense. Total assets stand at $27,720 million. The figure that instantly commands attention is their liquidity. They are sitting on a cash and cash equivalents pile of $16,024 million.
Yes.
That is $16 billion in highly liquid capital. It is an absolute fortress. We also see goodwill sitting at $2,662 million, which represents the premium they paid over book value for past acquisitions, companies like Kayak, OpenTable, and Agoda.
The $16 billion cash pile is undeniably formidable, but an auditor never evaluates assets in a vacuum. We must scrutinize the liabilities that are funding those assets.
Right. Where did the money come from?
They are carrying a substantial debt load. $15,398 million in long-term debt, compounded by another $3,015 million in short-term debt obligations.
That is a lot of leverage.
It is. However, I want to redirect our analytical focus away from their traditional corporate debt and toward a very specific critical line item, deferred merchant bookings.
Oh, yeah. Deferred merchant bookings surged to $8,189 million this quarter. That is up massively from the $5,270 million they reported at the end of 2025.
It's a huge swing.
What exactly drives this nearly $3 billion swing in a single quarter?
This specific line item is the absolute holy grail of Booking Holdings' modern business model. It represents the concept of negative working capital, and it is a financial superpower.
Okay, explain that.
Under their merchant business model, let's say a family in New York goes to Booking.com in January to plan a 2-week summer vacation to Greece for July.
Nice trip.
Right. The family inputs their credit card and pays Booking.com the full amount today, in January. Booking captures that cash instantly. But crucially, Booking does not remit payment to the hotel in Greece until the family actually checks in 6 months later in July.
Oh, wow. So they just act as a holding pen for the global travel economy's cash.
Precisely. That $8.189 billion in deferred merchant bookings is essentially a massive short-term, interest-free loan forcefully extracted from the traveling public.
That's wild when you put it like that.
They hold the cash, but because they have not yet facilitated the actual stay, the accounting rules require it to sit on the balance sheet as a liability. But unlike their $15 billion in corporate bank debt, this $8 billion liability costs them absolutely nothing to service.
Right. They aren't paying interest to the family going to Greece.
In fact, it is an active revenue generator.
Because of the macroeconomic interest rate environment. If you are sitting on over $8 billion of customer float for weeks or even months before you are obligated to pay the hotels and airlines, you don't just leave it under a mattress.
Exactly.
You park that cash in short-term, risk-free instruments like treasury bills and earn a substantial yield on it.
It is a hidden, highly lucrative profit engine that requires zero capital expenditure and zero marketing spend to maintain. They are literally monetizing the time delay inherent in travel planning.
That is brilliant.
Now, returning to their actual interest-bearing corporate debt, the $15.4 billion in long-term debt, what is fascinating is how strategically Booking utilizes it. A highly significant portion of this debt is denominated in euros, not US dollars.
Okay, why would they do that?
They intentionally use this euro debt as a net investment hedge to protect their European subsidiaries, specifically Booking.com BBV, which is headquartered in the Netherlands.
Walk us through the mechanics of a net investment hedge.
Yeah.
How does borrowing money in a foreign currency actually protect the company?
Well, Booking Holdings is a U.S.-based parent company, right? Reporting its consolidated financials in U.S. dollars. However, its most valuable asset, Booking.com, generates its intrinsic value and cash flows primarily in euros. If the euro weakens significantly against the dollar, the translated value of Booking.com on the U.S. parent company's balance sheet plummets.
Which would destroy shareholder equity.
Exactly. To insulate against this, the parent company intentionally borrows billions in euro-denominated debt.
I see. So if the euro weakens, the U.S. dollar value of their European asset drops, but simultaneously, the U.S. dollar cost to repay that massive euro debt also drops.
You've got it. The asset devaluation and the liability devaluation effectively cancel each other out on the consolidated balance sheet. It is a highly sophisticated treasury operation designed to strip currency volatility out of their equity valuation.
It proves that their balance sheet isn't just a static ledger of what they own and owe. It is an active, dynamic financial instrument they are managing to hedge global macroeconomic risks while simultaneously playing the float on billions of dollars of traveler cash.
Another key area is point 4, cash flow. This is where the theoretical accounting meets hard financial reality.
We've touched on their cash position, but let's actually trace the cash generation in Q1 2026. The reported net income, as we established earlier, was $1,083 million. But to arrive at the true operating cash flow, we have to bridge the gap by adjusting for non-cash items.
Right. I demand strict adherence to cash reality over accounting fiction. Net income is an opinion crafted by accountants. Cash flow is an undeniable fact.
So how do we find the fact?
To find the actual cash generated, we begin with that $1.08 billion net income figure and systematically add back the expenses that suppressed profit on the income statement but did not actually consume cash this quarter.
Okay.
So we add back $131 million in depreciation and amortization. We add back $141 million in stock-based compensation because they paid their engineers and executives in newly minted shares, not out of the cash reserves.
That makes sense.
And crucially, we must subtract out that $333 million unrealized foreign exchange gain on the euro debt. It inflated the net income, but no actual cash entered the treasury.
Because it was purely a paper gain based on an exchange rate snapshot.
Right.
But the absolute behemoth driver of their cash flow circles back to the negative working capital you just explained. The massive change in deferred merchant bookings. In Q1 2026, the seasonal influx of deferred merchant bookings generated a staggering $2,919 million in cold, hard cash.
This is where we conduct a crucial forensic test, calculating the accruals ratio. We compare the operating cash flow to the net income.
Okay, let's do the math.
When you factor in that nearly $3 billion tidal wave of cash from deferred bookings and strip out the paper FX gains, their actual operating cash flow is estimated to be vastly higher than the net income, well over $4 billion for the quarter.
Wow.
Because the cash flow so thoroughly dwarfs the $1.08 billion net income, their accruals ratio is deeply heavily negative. It means the company is generating far more actual hard cash than its income statement is legally allowed to suggest. The net income is lagging far behind the physical cash generation. This is entirely dictated by the seasonal surge in vacation bookings in the first quarter. Booking is selling the tickets in Q1 for the global summer travel festival. The cash is safely secured in their treasury, earning a yield, while the conservative income statement is forced to wait for the summer check-ins to catch up.
And because they operate as a digital layer, they don't have to build physical hotels to generate this cash. Their capital expenditures, like what they spend on physical property, data centers, and equipment, are incredibly low relative to their revenue.
Which brings us to the ultimate metric of corporate efficiency, the FCF yield, or free cash flow yield. You calculate this by taking the free cash flow, which is operating cash flow minus capital expenditures, and dividing it by the company's market capitalization.
Right.
Because their CapEx is effectively a rounding error for an enterprise of this magnitude, their free cash flow is enormous. Therefore, their FCF yield is incredibly robust, cementing their status as a highly attractive, asset-light cash generation machine for institutional investors. Moving to point 5, outstanding shares and market capitalization. We need to contextualize the sheer scale of this entity.
Let's quantify that scale. According to the Q1 2026 10Q filing, the exact number of outstanding shares is 774,878,436 shares.
A very precise number.
Very precise. When you multiply that by their share price, you arrive at a market capitalization of $134,348.42 million. Let's call it $134.3 billion.
It's massive.
I think it is vital to pause and truly conceptualize what a $134 billion company looks like in the travel sector.
Yeah.
Booking Holdings is larger by market cap than many legacy airlines and global hotel chains combined.
Easily.
If you combine the market caps of Marriott, Delta Airlines, Hilton, and United, Booking still dwarfs them. And they have achieved this valuation despite owning virtually 0 airplanes, 0 physical hotel properties, and employing exactly 0 housekeeping staff. They have constructed the ultimate digital toll booth.
They do not own the supply, they own the demand. And the fundamental rule of the modern digital economy is that whoever aggregates and controls the consumer demand ultimately dictates the terms to the fragmented supply base.
The hotels have no choice but to list with them.
Exactly. But I want to scrutinize that exact share count you highlighted. 774.8 million shares. That is not a static figure. It is shrinking rapidly.
Driven entirely by their aggressive share repurchase program, which I know we are going to debate heavily in Section 8. But mechanically, when management utilizes billions in cash to buy their own shares on the open market and immediately retires them, the total pool of outstanding shares decreases.
Yes, the denominator shrinks. The total intrinsic value of the enterprise does not fundamentally change simply because they executed a stock trade, but the number of slices in the pie decreases.
Right.
Shifting focus to point 6, risks. This is where the pristine narrative begins to fracture.
Let's examine the dark clouds gathering on the horizon, because the source material highlights several highly material risk factors. The first, and most alarming, is a massive legal and pension black hole involving the Dutch pension fund, known as the BPF litigation.
This is a big one.
The Dutch courts have ruled that Booking.com must join the mandatory travel industry pension scheme, and this ruling is shockingly retroactive all the way back to 1999. Second, we see severe regulatory fines. They took a $530 million accrual hit back in 2023 regarding actions taken by the Spanish Competition Authority.
Sure.
Third, we have significant goodwill impairments. Kayak, one of their marquee brands, took a massive $457 million impairment hit in 2025.
Yep.
And finally, there are ongoing hostile tax audits, specifically protracted battles with Italian tax authorities over transfer pricing mechanisms and value-added tax calculations.
I want to stop you because it is very easy to list these out as bullet points, but we must understand the underlying structural threat. Let us bring the hammer down on this BPF pension risk.
Okay, let's get into it.
This is not a standard regulatory fine for aggressive marketing. This represents an existential failure of risk management and legal strategy.
Well, I push back on calling it a failure of risk management. I mean, they fought this classification aggressively in the Dutch courts for over a decade. They utilized every legal avenue available to them.
And they ultimately lost at the Dutch Supreme Court. We have to analyze why they lost and what it means. Booking's entire valuation is predicated on being classified as a lightweight technology platform, a software company that merely facilitates connections. But the Dutch courts ruled that they are, in fact, a travel intermediary, essentially legally equating them to a traditional heavy footprint travel agency. I want you to imagine opening your corporate mail today and finding a finalized bill from a government entity demanding 27 years of retroactive pension contributions for thousands of employees.
Oh man, that's brutal.
Compounded by decades of interest and severe penalties, it is a catastrophic black hole of liability. They had to accrue hundreds of millions of dollars just to prepare for it, and the final bill is still being actively negotiated. When a core subsidiary like Booking.com BV, which is the absolute crown jewel of the holding company, faces a retroactive reclassification of this magnitude, it threatens the foundational economics of their entire European operation.
If they are legally forced to operate under the strict labor, pension, and union rules of legacy travel agents, that incredible 20% operating margin we discussed earlier could structurally degrade. That is a very sobering perspective. What about the Italian tax audits regarding transfer pricing?
Transfer pricing is how multinational corporations move profits between subsidiaries in different tax jurisdictions. Italy is essentially arguing that Booking.com's Italian operations generate massive value locally, but the profits are being unfairly shifted to the parent company in the Netherlands or the US to avoid Italian taxation. When a sovereign nation targets your transfer pricing architecture, they are attacking your global tax efficiency.
Let's move to the kayak impairment, because a $457 million write-down is just jarring.
This is perhaps the most strategically alarming figure in the entire Q1 report. An impairment charge means management and their auditors have formally conceded that the asset is permanently worth hundreds of millions of dollars less than what they originally paid for it.
It's gone.
Yes. We must ask the forensic question. Why did Kayak hemorrhage nearly $500 million in intrinsic value?
The sources cite that customer acquisition costs for Kayak are rising significantly.
Yes, but why are they rising so aggressively? It is because the fundamental metasearch business model is dying. Kayak was built on the premise of aggregating search results, scraping flight data from Delta, United, and Expedia, and displaying it visually for a consumer to compare. But generative AI is bypassing traditional visual aggregators entirely.
Oh, because of the AI agents.
Exactly. If a consumer can simply speak to an AI assistant and say, book me the cheapest flight to London, the AI interfaces directly with the airline's back-end APIs. The visual metasearch middleman Kayak becomes entirely obsolete.
Wow. So they are just getting squeezed out.
To combat this irrelevance, Kayak is being forced to spend unsustainably high amounts on marketing just to acquire dwindling traffic that is naturally migrating to AI-driven interfaces. The $457 million impairment is a stark, permanent admission by management that the future cash flows of the meta-search model will never justify its historical valuation.
That is a profound realization.
What about the point 7, opportunities and strengths? We must balance the ledger by examining their strategic counteroffensives.
Well, despite the severe risks, the business possesses immense momentum. Let's look at their strategic vision to combat these threats. The core opportunity they are aggressively pursuing is the connected trip vision.
Right, the super app idea.
Exactly. They are attempting to build an end-to-end AI-powered itinerary ecosystem. They want to control your flights, your hotels, your local attractions, and your ground transport, all centralized in one interface. We are already seeing the success of this strategy in their flight vertical, where they reported a massive 37% year-over-year growth in flight tickets booked.
That is substantial growth.
It is. And finally, the most significant shift, the massive pivot from the legacy agency model to the merchant model. Merchant revenues hit an astounding $3,698 million, vastly outpacing the traditional agency revenues, which languished at $1,528 million.
That pivot is the most important trend in the company right now.
I have to admit, looking at this through the lens of a consumer, the connected trip is exactly what I want. The current fragmentation of travel planning is deeply annoying. You have a spreadsheet for flights, a separate app for the hotel, another app for Uber.
It's a headache.
The idea of using an integrated generative AI assistant to seamlessly book a ride from the airport, a boutique hotel in Rome, and secure skip-the-line Coliseum tickets, all within a single chat interface that actually knows my preferences. That is the holy grail of travel. It entirely removes the mental friction of logistics.
The consumer convenience is undeniable, and it is a brilliant marketing narrative. But as an auditor, I do not care about the seamlessness of the user interface.
Of course not.
I care about the underlying financial genius of why they are so desperate for you to book every single leg of your journey through their proprietary ecosystem. And that financial genius is entirely encapsulated in the pivot to the merchant model.
Let's clearly delineate the difference between the agency and merchant models, because it fundamentally changes what kind of company Booking is.
In the traditional agency model, Booking functioned as nothing more than a digital bulletin board. A traveler books a hotel in Paris on Booking.com, but they do not pay Booking.com. They arrive in Paris, hand their physical credit card to the hotel clerk, and the hotel processes the payment. Weeks later, the hotel sends a 15% commission check back to Booking. Booking is just a middleman earning a referral fee, taking zero payment risk.
Like a traditional real estate broker. The broker introduces the buyer or the seller, but the broker doesn't actually buy the house or hold the mortgage. They just collect a commission check at the closing table.
Exactly. It is a capital light but low control model. But in the merchant model, Booking completely inverts the dynamic. They act as the actual digital storefront.
Okay.
The traveler inputs their credit card directly on the Booking.com platform. Booking controls the primary payment gateway. By aggressively controlling this gateway, they capture the cash instantly, which creates that massive $8 billion deferred revenue float we analyzed earlier.
Right, the free loan.
But the strategic dominance goes much deeper than the float. Because they process the transaction, they capture lucrative foreign exchange conversion fees, they capture merchant payment processing margins, and they can offer high-margin integrated financial products like buy now, pay later insurance.
Wow, they cease to be a travel search engine.
They are quietly but rapidly transforming into a highly specialized global fintech platform. They are essentially operating as an unregulated digital bank that specializes exclusively in global travel transactions.
That is wild.
The merchant model allows them to relentlessly monetize the actual movement of the money across borders rather than just taking a flat fee for booking a bed. That is why merchant revenue has exploded to $3.7 billion. It is a strategically brilliant, highly defensible moat that physically locks the consumer and the hotel into their financial infrastructure. Another key area is point 8, management credibility and capital allocation.
Let's talk about what management is doing with that staggering $4 billion in quarterly operating cash flow. In Q1 2026, management executed stock repurchases totaling $4,022 million.
That's a massive number.
They vacuumed up and retired 22 million shares in a single 90-day window. On top of that aggressive buyback, they initiated a dividend, paying out $333 million to shareholders. Looking at this strictly from the perspective of an equity investor, it is hard not to applaud. Returning over $4.3 billion of capital to shareholders in a single quarter is a staggering display of financial omnipotence. It telegraphs immense confidence from the boardroom and is aggressively shareholder-friendly.
I remain highly skeptical of management's financial reporting habits, and I fundamentally question their definition of friendly capital allocation.
Okay, lay it on me.
Let us first rip into their preferred performance metric, which they use to justify these buybacks. Segment-adjusted EBITDA less CAPEX. This is a deeply non-GAAP, heavily massaged, and highly manicured number. To arrive at this figure, management conveniently strips out the cost of stock-based compensation, which amounted to $141 million this quarter. Furthermore, as we discussed in Section 2, they are also stripping out the $25 million in supposedly one-time transformation costs, pretending they are anomalous when they are, in fact, routine, ongoing expenses.
Yeah, that was a red flag.
When executive management consistently relies on heavily adjusted, bespoke metrics to narrate their operational success, an auditor's baseline level of trust drops significantly.
I can see that the reporting metrics are aggressive. But regarding the capital allocation itself, isn't buying back $4 billion in stock an inherently good thing for the remaining shareholders? It drives the EPS up.
I pose a very tough structural question to you and to our listeners.
Yeah.
Is it genuinely prudent?
Well,
let us look at the full, unvarnished picture of their liabilities. The company is carrying $15.4 billion in long-term debt in a volatile interest rate environment. They are actively facing hundreds of millions of dollars in retroactive pension liabilities in the Netherlands that could force a structural reclassification of their business model.
right.
They have massive 9-figure regulatory fines from the European Union pending. They're operating in a macroeconomic environment where their subsidiary Kayak just lost $500 million in permanent value because of generative AI disruption. In that specific context, is blowing $4 billion of liquid cash on stock buybacks in 90 days prudent capital allocation.
When you frame the buyback against the totality of those existential risks, it looks considerably less like confidence and almost bordering on reckless.
Exactly.
Why not pay down the $15 billion debt load? Why not build an impenetrable cash war chest to fight the European regulatory battles or invest billions heavier into developing their own proprietary AI models to defend against the threat to their search dominance?
Exactly. We must ask, is it prudent capital allocation designed to protect the 10-year future of the enterprise? Or is it just executive compensation padding? Remember, executive bonuses and stock options are almost universally tied to hitting specific earnings per share targets.
Oh, I see where you're going with this.
If executives utilize the company's treasury to buy back shares, they artificially inflate the EPS mathematically, ensuring they hit their bonus targets and secure their payouts, regardless of whether the underlying core business actually grew or if the regulatory risks were mitigated. Moving to point 9, forensic verdict. It is time to synthesize our findings.
We have covered a tremendous amount of complex ground today. Let's synthesize the true underlying health of booking holdings based on the Q1 2026 data.
Go ahead.
From a pure consumer and market dominance perspective, the long thesis remains incredibly robust. Booking remains the undisputed heavyweight king of online travel. Their global scale is virtually unmatched. Their aggressive pivot to the merchant model is successfully locking in travelers with integrated, frictionless payments, and their strategic push toward the connected trip using AI to manage complex logistics is exactly what the modern consumer is demanding.
True.
The core operational engine of collecting cash upfront from travelers, holding the float, and distributing it later to fragmented hotels is a practically bulletproof business model.
I will concede that the core cash generation is undeniably spectacular. We prove that mathematically by examining the deeply negative accruals ratio and the massive $8 billion mountain of deferred merchant bookings. They are an absolute cash printing machine, endlessly fueled by global wanderlust and their dominance of the payment gateway.
I hear a but coming.
But as a lead auditor delivering my final unvarnished sign-off on this quarter, I must issue a severe warning regarding the integrity of their income statement. The reported Q1 2026 net margin of 19.58% is an illusion. It is a highly manicured house of cards built on euro debt, foreign exchange paper gains, interest expense relief, and one-off legal settlement offsets.
Not core travel profits.
Right. The income statement is not a clean reflection of operational excellence. It is a messy, volatile minefield of regulatory fines, goodwill impairments masking structural decay in their meta-search divisions, and aggressive, non-core financial engineering.
So to summarize for the listener, the company is fundamentally deeply rich in actual cash, but the narrative story they are telling Wall Street about their scaling profitability and margins is highly distorted.
Yeah, precisely. The forensic verdict is this: do not trust the headline net income. Follow the actual operating cash flow. Respect the immense power of the merchant float, but remain highly, highly vigilant of the massive debt load, the questionable prudence of their aggressive share repurchases, and the looming existential threat of European regulators reclassifying their entire foundational business model.
What an incredible journey through the ledger. Thank you to everyone for joining us on this rigorous earnings report. We started this hour by talking about the magic and escapism of planning a holiday, but hopefully you now possess a deep understanding of the complex, high-stakes, and occasionally precarious financial machinery that makes that magic possible.
Before we officially sign off, I want to leave the listener with a final unmentioned concept to ponder. We spent significant time unpacking their pivot to integrated payments and their grand vision for the connected trip.
Right.
If Booking Holdings successfully executes this vision, if they integrate generative AI so deeply that it plans every single aspect of your trip from inspiration to physical itinerary, and their merchant model acts as the sole payment gateway handling every single financial transaction along the way, do they cease to be just an online travel agency? At what specific point do they transition into a sovereign digital economy for global tourism? If they absolutely control the initial consumer demand, the underlying payment rails, and the behavioral data, are they rapidly approaching a terrifying tipping point where they can dictate pricing terms and margins to independent airlines, hotels, and restaurants with absolute monopolistic authority?
A sovereign digital nation-state of travel, dictating terms to the physical world. That is a chilling and utterly fascinating thought experiment to end on.